All right, so I'm assuming you guys can see my screen. So what I'll do is I'll give a brief overview of who we are at Itron, what the market looks like. Then I'll go into the strategy of the company, um, what our technology is and why we have a leadership position there. And then we'll get into some financials, both near term and then long term. So what do we do at Itron? So we help utilities manage energy and water more efficiently. So utilities are our customer. We don't have any customers beyond that. But what I mean by manage energy and water more efficiently is in particular at the edge of the grid. And when I say at the edge of the grid, in simple terms, it means at the meter on the side of your house. So we produce electric meters, water and gas, and we can service all three of those under one Itron network. And so we've been around for 40 years, and back then it was very focused on just shipping meters, very hardware focused. But over the last, I'd say 10-ish years, we've grown a software component of our business. And we're really at the point where it's about managing data, providing visibility on the grid for the utilities, and then ultimately being able to control that data to harness energy in one particular area that needs it. So Itron today, we have 8,000 customers across 100 different countries. So we're in every region across the globe. We have 270 million communicating endpoints around the world. And when I'm talking about endpoints, most of those are meters, like I just talked about. But we also have network interface cards that can plug into older meters to make them smart. And I guess a good comparison there is if you have an older TV in your apartment, you could plug in like a Roku device or a Fire Stick to make it smart. That's what we can do as well. So we have 270 million of those around the globe. 100 million of those are under our management, which means that we're providing some sort of service on a recurring basis. Some of it can just be as basic as managing the usage once a month and doing the billing for the utility. But where the real profit is detecting where electric vehicles are plugging in on the grid, who has rooftop solar panels that maybe is generating a surplus of energy, who has a pool pump, who has a smart thermostat, that type of thing. All these provide or basically are creating volatility on the grid, and that's creating a lot of problems for the utilities. If you can imagine 30 years ago, a family of 4 in a particular house with a dog, the electricity that they demanded was very predictable, except for maybe Christmas and Thanksgiving when you had your relatives come and visit. So back then it was very predictable, but it's not that predictable anymore. With the electrification of just about every device that we use, you're plugging in your EV, your e-bike, your iPad, your iPhone. And like I said, some houses have solar panels, some of them have a pool pump, some even use wind power, and all that creates volatility, which is creating problems for utilities. So beyond the endpoints under management that we also have a subset of that, which is distributed intelligence enabled endpoints. And so we only have 12.4 million of those out in the field. Distributed intelligence is in the very beginning stages. To use a baseball analogy, we're probably in about the second inning. And ultimately, what we would like to do is have all of our communicating endpoints have some sort of distributed intelligence capabilities, whether it's plugging in a network interface card or just replacing their older vintage meters with our latest smart meters. And to put it in a nutshell, distributed intelligence is kind of what I was just talking about. It's managing the volatility on the grid, detecting where EVs are plugging in, where power outages might be, and then controlling that data. And like I said, we're in the very beginning stages there. And that's really where the growth of the company is going to come from over probably the next decade or two. Kind of rounding it out, so we have 5,000 people here at Itron, not counting contractors. And then we have over 250 partners that help us develop apps. So our smart meters, you can think of those as like an iPhone on the side of your house. Whereas an iPhone can certainly make a phone call, but it can do a whole lot more than that, usually by using apps. And it's the same thing with our smart meters. We can download an app. If your house has an EV plugging into it, we can download an app to help manage that EV. We can download an app for rooftop solar panels and so forth. And so we rely on our partners to develop those apps. Then the pie graphs out to the right. We're divided into three segments. Device solutions is a little bit more Europe focused, and that's about 21% of our business. Network solutions is 67%, and outcomes is the smallest piece. That's where the software resides. That's only 12% today. And I'll get into a little bit more about what these segments do here in just a minute. And then we're predominantly focused in North America, mainly because that's where the market opportunity is the most robust. In Europe, there's more regulation. They have government-sponsored networks, and so it's harder to set up our own network and then put our outcome solutions on top of it. We want to package the whole thing together so that we get the most margin. And in the US, it's a lot easier to do that. So what are the market opportunities out there? What's the demand look like? And so we separated into three buckets, kind of really driving the demand for our products and why do utilities need to harness data? Why can't they just do what they used to do and just bill usage once a month? Well, for one thing, you got infrastructure that's getting old. And when you have a transformer that was built 50 years ago in your neighborhood and you're plugging in an electric vehicle, and then maybe you got 5 or 6 more electric vehicles because your neighbors get jealous and they want one too, that's going to create a transformer to overload and potentially fail. Then we also have solar and wind generation that's happening now. Again, creates volatility on the grid. And then sometimes you have battery storage. If you have a Tesla electric vehicle, you may have a battery storage capability as well. And if you have distributed intelligence, which is our solution, you could actually sell that battery energy back to the grid. The second bucket would be extreme weather or environmental. You've seen a couple of hurricanes already this year with Helene and Beryl create lots of problems, lots of power outages for people. With our solutions, the power outages are detected within seconds. And not only that, but it sends to the utility what exactly went out. Was it a meter? Was it a transformer? Did a tree limb fall on power lines and knock it down? And that way the utilities can roll a truck immediately, know exactly what they need to go fix or replace. They know exactly how many engineers or how many experts they need to take on the truck with them. And it's just a whole lot more efficient about getting the power back on for customers. And then lastly, on the social aspect of it, we're used to dealing with big data, massive amounts of data in our daily lives. And what I like to liken this to is if you can call an Uber and you can see where your driver is, you know the driver's name, what kind of car they have, license plate number, when they're going to pick you up. We should have that same capability when your power goes out. When is the utility going to get it back on for you? When are they going to roll a truck to go fix the problem? What exactly is the problem? And all of that is allowed under our solutions. So now getting in more to what is our strategy to go to the market. So here are the three segments again. So I'm going to start at the bottom of the pyramid. Device solutions has historically been more of our older technology and sometimes even mechanical non-communicating devices or meters. Over the last few years, we've been purposely exiting some products or geographies that don't fit our margin profile. And a lot of that has been, we've been selling off some of that older mechanical type meters. So if you're looking at historical Itron financials, devices at one point was 900 million a year of annual revenue, but now it's down to about 450 million. That's been very purposeful because that's the lowest margin segment of our business, and we want to exit those types of products. But we do have to maintain some device solutions still, because we also, part of the strategy is just kind of to service utilities that maybe are in rural areas that don't need a network necessarily. Maybe in 10 years they're going to need a network, but we want to go ahead and lock up that customer as an Itron customer and then provide them more capability as they need it in the future. So moving up the pyramid, so network solutions, this you can think of our smart meters that connect on an Itron network. This is where all the hardware resides. So it's not just the meter, it's all the network equipment. The networks we have, they can talk on, they can go through cellular, they can go through fiber, Wi-Fi, 900 megahertz mesh. So it's a very complicated network, but it's all done in-house. It's all very secure. If you can imagine, our customers are utilities, so cybersecurity is very important to us. You can't have hackers hack into the network and turn the power off for your customers. So that's where all the hardware resides. And then the outcomes section, that's where that distributed intelligence data analytics are going to reside. That's what is the newest to the company. That's outcomes. The distributed intelligence capability is only close to 5 to 6 years old. But that section of the company, that segment, is what we want to grow the fastest, because it also has the most margin, or the highest gross margin. So how do we use all three segments when we address a customer and their needs? The first thing we want to do is establish the customer as ours, because utilities typically will stay with a provider for 10 to 20 plus years. It's very expensive to rip and replace systems once they go with someone like an Itron. So whatever their needs are today, we want to go ahead and land them as a customer. And it could be that maybe it's just meters that they want. Maybe they don't need a network yet, but we'll go ahead and ship those meters to them and set it up for them. That way that they're our customer, and they always will be, at least for a few decades. And then once we land the customer, or in hopes that we could actually set up a network for them, then we can sell every solution, every device, every kind of data analytics that we offer through outcomes, and kind of upsell that part of the business. And then also having that one network set up, we can service electric, water, gas all under one network canopy. We can also service smart cities. I'll get into that in just a little bit, but that's a very big advantage for Itron versus the competition. No one else can do electric, water, gas under one network canopy. And one example of that is in San Antonio, Texas. The energy provider CPS Energy, they had an existing Itron network, and then the water provider, San Antonio Water, approached us and said, hey, we want a network just like CPS. And we told them, you don't have to buy another network. It's already set up over San Antonio. You just have to leverage that same network. So CPS and San Antonio Water were able to make an agreement with our help, and both utilities were able to save a lot of money by leveraging that one network. So a little deeper on our network and on our platform. It's very flexible, but it's also device agnostic, which is very important. Utilities don't always want to spend all their money with one vendor like Itron. Of course, we want them to, but if they want to diversify, that's okay with us. So if they want to go with a competitor's meter, we can actually make that work on our network. So if a Badger meter, or if an Aclara meter, and a Landis and Gear meter, if all of those can work under our network. We aren't as focused on hardware anymore like we were maybe 20 to 30 years ago. We really want to manage the network and manage the data for the utility first and foremost. Again, that's where the highest gross margin is. So we're very flexible in our network platform, and that was very purposeful. The other thing we have is it's backwards and forwards compatible. So as the needs of the utilities grow, we can just download an app to the meters, and it's ready to go. So that network, once it's set up, it can be there for decades. And then what exactly do we offer? I've kind of talked about smart meters and the software analytics that go with it. But the latest technology, when I talk about a network, is that I'm talking about an advanced metering infrastructure network. We call it AMI. That's the two-way communicating network. Utilities, they no longer have to send a meter reader out to the house and write down on a piece of paper and a clipboard what the meter usage is. Everything can be read through the meter. The signal sent back to the utility through a cellular network, or 900 megahertz mesh network, fiber, and so forth, whatever works for the customer. That's our leading technology. We also still offer an older technology called automated meter reading. That technology is probably about 30 years old. It's not really on a network, but what it is a utility can roll a truck or a van in a particular neighborhood, and we have a handheld device, and it can read the meters within close proximity. So they don't have to get out and read it by hand, but they do have to drive a truck in the neighborhood. They can read a dozen different meters, keep driving down the road and read more meters. It's not nearly as advanced as an AMI network, but if we're talking about rural areas of the country that don't need a network yet, we can go ahead and land them as a customer with some of that older technology that we still sell. And then I'm going to jump down to the smart city applications. That's a pretty small part of our business now, but it does have a lot of growth potential. And what we're doing there, again, under the Itron Canopy network, is we can manage smart street lighting. We've set up smart street lighting in Paris and a few other cities in Europe. And some of the advantage to that is we have like acoustic detection, so gunshot detection. And so if, say, a gun goes off, the smart street light would start to flash to kind of alert whenever the police arrive on the scene. That flash would signal to them that this is exactly where the gunshot happened. All the while sending a signal to the police on, hey, a gunshot went off. No one has to call 911 or anything like that. They can be alerted as soon as that gunshot goes off. So pretty neat stuff there. It's just a small part of our business, but again, a lot of potential to grow there. And so grid edge intelligence, really what that's about, you've heard me say it a few times already, is it's really about the visibility on the grid. And where we play is more on the edge of the grid, which is at the house. And so on the right side of the chart where it says millions of endpoints, that's where we operate. Now on the other side of it, that's from the power station down to the substation. The substation is kind of like a mini power plant in your neighborhood. We don't really operate there, but there is opportunity there, and there are some competitors or other companies like GE Vernova, Schneider Electric. They kind of play more upstream on the grid, and we've actually announced some partnerships with them recently so that we can combine our grid edge intelligence at the house with a smart meter with Schneider Electric's operations that are happening more at the substation level. We can package all that together, present it to the customer as one holistic solution, kind of like an easy button for the customer. And they do like that. It's been generating some pretty good opportunities in our pipeline. So diving a little bit deeper on grid edge intelligence, really what it does, first and foremost, you have to be able to build usage accurately. That's kind of table stakes at this point. But then there's also grid planning that it does. If a city is growing, they need to build out new neighborhoods. Our grid edge intelligence can help them plan for how much power they need. The distributed energy resources, what that really is rooftop solar panels, wind power, anything that's generating power that's not your traditional power plant. Electric vehicles that get plugged in. This one's pretty neat because, I live in Texas, and in the summertime, it gets, triple digits heat-wise in the summertime. Everyone's blasting their air conditioners at full blast. But when people come home with their electric vehicles and they plug them in at 5 or 6 p.m., that creates a tremendous load on the grid. And in some cases here in Texas, it's caused brownouts. And so what this EV optimizer solution does is it incentivizes the customers to not charge their electric vehicles at 5 p.m. when it's the hottest outside. It will now charge it at maybe 2 a.m. when the sun's long since gone down and it's not so hot outside. But they don't have to actually unplug. They can plug in their EV at 5 p.m. Maybe it'll charge it at like 25% of the capacity. And then at 2 a.m., it'll go ahead and ramp it up to 100%. And of course, they'll get incentives on their electric bill, some credits so that they're compensated for participating in that kind of plan. Some of the benefits, of course, it's going to reduce operating costs. So that's kind of the ROI that we look at, or what we present to customers. It's going to be very reliable and resilient, but really utilities are also very interested in the carbon reduction because they've got goals to meet sustainability goals with their investors. They've got to reduce their carbon footprint, and this is a good way to do it because they don't have to roll as many trucks to go read meters, to go fix issues on the grid when the power goes out. So it's a good way for them to reduce their emissions. So what this slide is so we've been on a journey here, an asset light journey, and that's kind of corporate jargon for we've been reducing our factory footprint. Excuse me here. So prior to 2016, we had 30 factories across the globe. And here at the end of 2024, we're going to have only 6. A lot of that has been factory consolidation, but it's also been outsourcing our manufacturing to contract manufacturers. And what that really does is it puts the burden of utilizing factories efficiently on a contract manufacturer instead of us having to manage it. It also puts the burden of managing supply on a contract manufacturer. Really what this lets us do is concentrate more on selling our network and selling the managed services that's about managing the data on the meter that we want to focus on. And then from a technology standpoint, why Itron? Well, we have the grid edge intelligence technology that I've just talked about. We have the 250 partners that we partner with. We're not trying to reinvent the wheel. If someone else has already invented it, we'll go ahead and partner with them. But really distributed intelligence, it's the technological advantage that no other competitor has. And so from our standpoint, that's driving demand higher than it's ever been. So now let's get into some financials. But before I do that, I just wanted to level set on what's happened to Itron over the last few years. So if you're researching Itron, you go back to 2019 or the end of 2020, the financial performance has taken a dip and then it's had a recovery. So we were heavily impacted by COVID. When COVID hit, our customers approached us and said, hey, you can no longer go and install meters at someone's house. We're scared people are going to die. Can't go in the house to hook up anything to their smart thermostats or anything like that. So we had a lot of project delays. And then after that, we had the supply constraints hit us pretty hard. We were constrained in semiconductors, and in particular, the analog semiconductors that the automotive industry uses. And so going up against Ford and Chevy and the likes, they have a lot deeper pockets than we do. So they were able to pay for supply up front with a large down payment of cash. And we just didn't have the cash to really compete with those type of companies. So you can see the downward trend there from call it early 2021 to end of 2022. So this is a stock performance chart here, but the revenue performance would mirror this type of trend. And so then we went sideways over about 4 or 5 quarters there, bouncing between $40 to $60 per share. And then we had recovery of supply, and you can see the upswing there that we've been on. So we were fully recovered on any kind of past due backlog or projects that were delayed. We finally fully caught up in Q2 of this year. So it's been a long journey for us, but we've been managing supply better. Some of that's been the contract manufacturing that we're outsourcing. That's been helping. But at this point, the financial results have been much improved. So now we're going to move on to the third quarter that we just reported on last week. So our revenue now is at $615 million per quarter. Back during the supply constraint era, that number had a 4 in the first digit, so in the 400 range. So we've improved quite a bit. EBITDA is $89 million, non-GAAP EPS $1.84, and free cash flow of $59 million. Keep going. And really what's happening in the business, we've continued our momentum. We've had 8 quarters in a row now of top line growth. Some of that's just catch up on supply, but it's also the demand side of it that I've talked about. We've had solid execution and team performance. So what that really means is the factories are running very efficiently. The contract manufacturers are performing the way that we thought they would. And one of the pluses about Itron is people don't tend to leave Itron. We've had some people here that have been here 20 to 30 years, but they do their jobs really, really well. And so that helps us generate more earnings. And then the market, as I've talked about, growth in energy and water needs, the demand out there has never been better. And then tracking to full year bookings expectations, that is probably the number one question I get from investors is about bookings. Internally, we don't really care about bookings quarter to quarter, but investors do, especially hedge funds. And so we produce a metric called book to bill. For us, billings and revenue is the same. So all that's doing is it's taking the bookings in a given quarter divided by the revenue. And so in Q3, we actually had a book to bill of under 1, so it was 0.8. And if you were to look at our earnings from Q1 and Q2, we also had a book-to-bill of under 1. And so the question would be, if I've talked about how great the demand is, how come the book-to-bill isn't above 1? And so first I should explain for us to put a project into backlog or to have it book, we have to have a signed contract from the customer, an agreed pricing agreement or a signed pricing agreement. But the last component to that is regulatory approval. Because our customers are utilities, any kind of new business has to go through a government regulator. And if you can imagine, anything having to do with the government doesn't usually move very quickly. And so while we've had plenty of awards of business, we haven't been able to book as fast as we would like, just because of that regulator component. You add on US stimulus funding that's been happening through IIJA or IRA, these government projects to upgrade infrastructure. That's added complexity to our business. And so, but what we've said on our last earnings call is that we fully expect to have a full year book-to-bill of at least 1 to 1. And that's helped kind of alleviate investors' worries. And the reason we have such confidence in that is because we've already got the signed contracts. We know that the regulator process has improved. And so what that would imply is that we're going to have over $1 billion of bookings in Q4. And our CEO would not have said that if he wasn't confident in doing that. So just to kind of some background there, we had record backlog in Q4 of 2023 at 4.5 billion. We've been working some of that down. Some of that's just because of the catch up on supply, but some of that's because we haven't booked as much as we would like to. But as I just described, with the large bookings quarter that we expect in Q4, you can expect next quarter when we report our earnings, that's probably going to be bumped up closer to our record levels that we had a year ago. Looking kind of at the GAAP P&L, so revenue improved 10% year over year compared to Q3 last year. And then on down the line, you can see everything has grown or margin has expanded. So because of our factories running more efficiently, our gross margin improved to 34.1%. That's 70 basis points better than a year before. Operating income, net income have all improved, and EPS, GAAP EPS was $1.70, which is pretty good for us. On the non-GAAP side of things, there on the right-hand column, again, growth across the board. Non-GAAP operating income was up 34%, falling all the way down to free cash flow. So all of these revenue growth, all the profitability growth, really doesn't mean anything unless your cash flow is growing, and ours is. So ours went up by 107%, and that's from an investor standpoint, cash is what they care about the most. Cash is king, as they say, and it surely is. So 59 million of free cash flow was a pretty good quarter for us as well. So looking at the financials by segment. So devices went up by 11%. Devices is primarily in Europe, so there is going to be some FX or exchange rate impact. So if you were holding those currencies constant, it would still be 10% growth. What you're seeing here is we've got noted here smart water and electric demand. So in Europe, we actually do have smart meters in our devices segment, but we sell them into the United Kingdom or France or Germany, in which they run their own networks. And so we do have some smart meters in the devices segment, but it just doesn't run on an Itron network. Gross margin increased 290 basis points. Again, that's the factory consolidations I've talked about. The team just operating very efficiently. We've got all the supply we need now, so the factories are highly utilized. That drove 290 basis points. And then just the gross profit falling down at the bottom line gave us a record quarter for operating margin and devices. So the network solution segments, this is again is where that network hardware resides. It's our largest segment. We just did 417 million. That was a record quarterly revenue for this segment. We've had new projects and ongoing deployments that have increased. So that's all driven by customer demand, high customer demand. And then because of the factory consolidation, again, this is impacting this segment as well. So that was 80 basis points, and that falls through to the bottom line as well for 110 basis points improvement. So Outcomes is a slightly different story. So what's going on here? This is our software segment. This is not to scale yet. This segment does probably about 250 million to 300 million a year. This is that software segment that we're in the early stages. So the revenue has increased, which we like. The gross margin has actually decreased. And what's going on here is we prefer to sell SaaS agreements to a customer, but sometimes we still have to do an upfront one-time software license sale, just so that they can capitalize it and put it into the rate base. But what that means is in Q3 of 2023, so prior year, we had some one-time software licenses that were almost purely 100% gross margin. And so it kind of juiced that quarter, and we didn't have those same amount of software licenses in Q3 of 2024. Over time, this is not a concern for us. This is just a 3-month period. But again, this segment is also not to scale yet. So any kind of movement in software licensing like that is going to move our numbers and create some volatility on that gross margin percentage. From a balance sheet perspective, we have some debt, but it's very low interest. Back in 2023, we issued convertible notes, 460 million for only 0% interest. So that was a no-brainer. And we just here in July issued 805 million of more convertible notes at 1.375%. Just to give you an idea, that cash balance we have there, the second to the bottom bullet, we have almost $1 billion in cash on our books right now. We're getting about 5% interest on that cash. So taking out debt at less than 2% and earning 5% back is a pretty good deal. Now, of course, we're not a bank. So what we're going to do with that cash, we've said it publicly that we want to pursue an acquisition that'll help that outcome segment grow. So that was part of the rationale of issuing more convertible notes at that 805 million, because we want to invest in the outcome segment and scale it faster. But beyond the $1 billion in cash, we also have a $500 million revolver that's been untapped. So that's kind of like a credit line out there from the bank. If we wanted to purchase an acquisition that was maybe more than $1 billion, we have that $500 million reserve that's ready when we need it. From an outlook standpoint, we've issued that the investors, Wall Street, they like us to give a forward-looking outlook on what we're going to do for the upcoming quarter and then also for the full year. Just kind of gives them more visibility on what we're going to be doing. And it also builds our credibility. If we actually do what we say, it helps management build up a lot of brownie points with our top investors. So we think we're going to do 600 to 610 million of revenue in Q4. That would represent a 5% increase versus the prior year. Non-GAAP EPS, we've got here that it's actually going to be down, but we had some tax adjustments in the fourth quarter of last year that drove the effective tax rate, or that ETR acronym. It was only 8% in Q4. If you normalize it for 25%, which we're experiencing this year, it would actually be 6% growth. So if you adjust it, we're still growing. It's nothing to be concerned about. And then full year, I put this chart on here just to show that we've increased our guidance twice. So we issue our initial guidance in February every year for the upcoming year. And there's the ranges. We issue guidance on revenue and non-GAAP EPS. At our mid-year conference call, which was our Q2 results, we revised our guidance upward for both revenue and EPS. And then kind of out of character for us, we went ahead and revised it again last week at our earnings call, just because our results have been better than expected. So we felt like we owed it to the street to show them a new range. And of course, the stock price reacted accordingly and went up last week. Now let's go on to long-term targets. And Ryan, I'm looking at my time here. I think I'm still in good shape, but I'll wrap it up probably in about 5 or 10 minutes.
Yeah, you're looking great. So yeah, take your time. We probably have 10 minutes is perfect for you. Yep.
Awesome. All right. So long term. So we had an investor day last March in New York. We were at the NASDAQ site in Times Square, and it attracted a lot of our top investors and our covering analysts. And a part of that investor day was unveiling some new targets. And so 5 to 7% CAGR through the end of 2027. to some businesses, that probably wouldn't look too aggressive or that attractive. But when you consider that we purposely are trying to keep devices flat, we don't want to grow that segment because it's the lowest gross margin. But we are trying to grow networks and outcomes where the margin is higher. When you consider that rotation of the business, it's going to put the company gross margin at 36 to 38%. If you'll remember in Q3, we had 34.1%. So that's a pretty good amount of increase or margin expansion for us. What that's going to do to free cash flow is be 10 to 12% of revenue. So that free cash flow will keep growing, and that drives up the stock price. So that's a good thing. So kind of digging into long-term targets more in dollar amounts instead of percentages. At the end of 2023, company revenue was about 2.2 billion. We think we're going to get anywhere from 2.6 to 2.8 billion by the end of 2027. But as you can see, kind of these the blue and the green bars there, outcomes and networks are going to grow. Devices we're trying to keep flat. Again, it's because that gross margin isn't higher than the other two segments. And then of course the gross profit dollars are going to grow as well, from about 700 million to somewhere between 940 and almost 1.1 billion. And then by segment, yeah, here you can see the devices segment on the left. Again, we're trying not to grow that one too much, but the margins are going to increase as we get more efficient with the factories. That'll give us another point or two of gross margin. Networks, which is our largest segment, will go from 1.5 billion to up to 1.7 to 1.8. And then outcomes, this is the story that we like to focus on. 268 million is subscale. As that segment scales, it'll get closer to that 43 to 45% gross margin target that we're looking for. This is more dollars to compare to. A lot of it I've already talked to, but I just wanted to have it on here in case you guys are looking back at the deck and want to know what do the dollars mean to the percentages. I'll go past that one. This chart here is how we're going to improve our gross margin. Because a lot of times we get, hey, your customers are going to be utilities. They're going to pay certain prices. You know, we've been in business for a long time, so we can't necessarily gouge one customer or another. Our customers talk to one another. So how are we going to increase our gross margin if pricing isn't a big lever that we can pull? It's somewhat of a lever, but not all of it. But the top box there, that revenue mix, if we sell less devices at lower margin, but more networks and outcomes at higher margin, that's going to give us 2 points of gross margin improvement between 2023 and 2027. We are going to have some pricing improvements just because with inflation that took off a year or two ago, we put in indexing into our contracts, and we've renegotiated some backlog projects. And then of course, every project that's in our pipeline that isn't contracted yet has our latest pricing. So that's going to give us about a point of improvement in gross margin. Then on that supply chain, I talked about the factories going from 30 down to 6 and relying more on contract manufacturing. That's going to give us another point of gross margin improvement. And then on the OpEx efficiencies, that won't affect gross margin, of course, because it's not in COGS, it's in OpEx, but it will help adjusted EBITDA margin. Really what that is about is we're right sized now. We have the right amount of salespeople and marketing. We have the right amount of G&A expense. So as the company grows, it's going to increase that operating leverage. But really, that disciplined discretionary spending, that's why I'm talking on a video today, and I didn't fly to Spokane because it's a lot cheaper to talk on a video. Our CFO likes to be efficient with spending, I should say. Hopefully she doesn't read this or watch this YouTube video. Capital allocation priorities. What this really means is how are we going to spend that $1 billion of cash that we have on our books? And we've been very open again about we want to pursue an acquisition. That's our number one goal. We don't really do we don't do a dividend. We're too small. We're in growth mode. We're not going to really do share buyback unless the stock price just gets, you know, to a point where it's kind of a no-brainer, but it's pretty high right now. So M&A is our number one priority. We're also going to continue to invest in R&D or research and development into that outcome space. Again, because our technology is really what separates us from the competition. So we want to stay ahead of the competition in that regard. So those two buckets, M&A and R&D, is where we're going to spend the money. And I think this is my last chart here. So why invest in Itron again? Not just from a technology standpoint, but from a financial standpoint. The P&L is in great shape. The balance sheet's in great shape. We have an advantage in our technology. The market is demanding that the utilities make a change because they have to address the electrification of the globe, the volatility on the grid. They need visibility. They need control. You got extreme weather events, hurricanes, wildfires in California. We can detect when electric lines fall with sensors on a pole. We could turn off the electricity within seconds, so it prevents those fires. That kind of technology, again, with our grid edge intelligence and those distributed intelligence endpoints that are already in the field and operating, and going from 12 million, we think, to a much higher amount here within the near future. Those are pretty exciting reasons to put your money into Itron. So with that, I think that is my last chart. These are just appendix slides. I'll flash up my contact information as well. So yeah, if beyond our Q&A session here, if you guys have any questions, feel free to email me. I can get back to you usually within the same day. And then Ryan, I don't know, do you have my contact information too? I guess you'll send out to the group.
I do, yeah. So kind of next steps is, yeah, I'll post this video on YouTube so you guys all have access to watch it as much as you want. The slide deck I'll email to everyone as well, so you have that. And then just for the rules of the competition, what we kind of ask is each university can ask 5 written questions, and then those will be due November 21st, so in 2 weeks. I'll kind of lump maybe some of those together so David doesn't have to answer as many questions, and then I'll take those answers and give them back to you guys. So through the rules, you can't actually email David directly because that could be kind of unfair for all the teams in the competition. But giving everyone an equal opportunity to ask their 5 questions once they've had a couple weeks to process this information and kind of come up with those 5 questions that you think will help with your presentation and analysis of Itron. But yeah, let's give David a round of applause. That was awesome and very well thought out. And thank you very much for the presentation. And now we can kind of open up to Q&A. Hopefully that kind of intrigues some interest, and I'm sure you guys have some questions from that presentation. So we'll open it up to anyone that has questions.
And if we want to get the ball rolling, you could ask me about what's it like living in Austin, Texas. We can do that first and get you guys off the mute button if you want.
Maybe I'll just kick it off to get it kind of started and let people think about it. But from kind of an investor perspective, it doesn't look like you guys have ever paid a dividend, knowing that you're kind of a growth kind of mid-cap company. That would make sense. But any plans for that? And then also, it looks like you've done some buybacks in the past. What's the kind of thought process of when to do that? And you talked about having some cheap debt. Is that something that you guys have ever considered doing more than you have in the past?
Yeah, as far as the dividend, no, our CFO has been pretty emphatic that we're not going to issue a dividend. We want to use our dollars to grow the business. Now, at some point in the future, maybe 5-10 years down the road, if we grow to the levels we want to be, yeah, maybe we can reconsider it. But here in the near future, a dividend's not really in our future, in our near future. Share buyback, it's typically, we have a share authorization in place, typically at all times. Sometimes it expires, we have to go back to the board and get another authorization, but it's really just for good financial practice. If something were to happen, like there was a macro event that crashed the stock market, we want to have that authorization there if it makes sense to buy back some shares at a cheaper price. We did buy back some shares also as a part of that convertible note issue that we did back in July, just to kind of offset some of that share dilution. But that's really what it's going to be used for. We want to return value back to the shareholders by just increasing the stock price through growth.
I have a question. So
Okay, yeah.
I know you said the number one goal of the company is to look for like a merger and acquisition. And I was
Mhm.
wondering kind of what the time frame on that is like and what in particular you're looking for. Is that more of like a research and development, something that you're looking to
Yeah,
um
that's a really, really great question. And that's a very common question I get from investors too. So we could make an acquisition at any time. So from our standpoint, we could make a move. That was part of raising some capital back in July. We just wanted to make sure we kind of had that dry powder to use in case the opportunity presented itself. The trick that we have, so there are targets out there. There's companies out there that have the technology that we like, but it's very bespoke or very tailor-made for maybe one or two customers. We have 8,000 customers, and so when we buy something, we want it to be scalable pretty quickly. We don't want to have to dump in our own research and development to make it scalable across a lot of different customers. That's probably our number one challenge. But we also want it to be accretive within 1 or 2 years. So we want it to generate revenue, free cash flow within 1 or 2 years. We don't want to get something that's just going to be a money pit for us. So that's what the challenge is. And then just the premiums that these companies want, especially for a software company, they still want to charge yesterday's prices. And so there's a little bit of that going on too. A lot of these companies are backed by private equity, and private equity, they typically will hold a company for 2 or 3 or 4 years, and they look to kind of pump up the earnings and sell it. So we're willing to kind of wait some of those out until they're getting kind of low on cash and can't pay their employees, and then they come to us with a better price. So some of that's going on. But yeah, the technology's out there. It just has to be something that we can scale pretty quickly. That's a very good question, though. Thank you.
yeah.
Yeah, if I may, I have another question.
Mhm.
So you mentioned Itron's international expansion to European countries. I was wondering what's your company's strategy to push further into like regions with more difficult or regulated environments? And do you see any country or continent or region as Itron's huge focus for the next few years?
So I'd say Asia Pacific, in particular, Australia and New Zealand are pretty big focus areas for us. It's fairly easy to do business there, kind of like it is in the U.S. Where we avoid, we don't sell into China just because of security reasons. We don't want them to get or know how to hack our technology and then hack into the U.S. We also can't really play in Japan because we're not a Japanese company. So there's definitely some market opportunity in Australia and New Zealand. It's just a very small piece of our business right now, but we do have a pretty large focus there because we can kind of take what we've done in the US and do exactly that in those two countries. In Europe, that's a hard place to do business. It's also very expensive. We have closed some factories in France here recently. Just again, because it's extremely expensive. Labor there is very expensive. And so the market opportunity for us is we do have relationships with the UK, France, Germany. Really, the smart cities applications is what we see in Europe as a growth opportunity. We want to manage their smart street lighting for them. At some point when we develop it a little further, there's like smart garbage, for lack of a better term. You know, if the dumpster's half full, they're not going to roll a truck until it gets close to full. So right now, the way sanitation works is they typically go get the garbage once a week. But if the dumpster's not full, why send a truck to go do it? So they can save money that way by only going to dump the trash when it needs it. So there's some of that going on. But predominantly, we want to keep selling the smart meters into those government sponsored networks because we do think that down the road they may transition to letting a private company or a private entity run their network for them. So we're kind of proving out now that our network runs a lot more efficiently than theirs, and one day maybe they'll turn it over to us. really good question so far.
Maybe another question for me is for a lot of these presentations, you focus on the positives of the growth and where you're expanding and kind of outlook, but maybe coming from more of like a SWOT analysis of the strengths, weaknesses, opportunities, threats. What are some like the weaknesses that you kind of see versus your competitors, or some of those threats that are the kind of the risks of what Itron is facing moving forward?
Yeah, from a technology standpoint, we're pretty far ahead, so that's not really an issue there. But the problem we face is utilities are pretty conservative. They don't really adopt new technology very quickly. A lot of times when we go to sell to a utility, they may need meters or maybe they want a network. But when we try to upsell the outcome solutions and manage the network for them and provide that visibility and control, a lot of times their first reaction is, hey, I've got 2 or 3 IT guys in the back shop here and they can do that. Don't worry about it. And so what inevitably happens is we turn the data over to them to manage. Within a few months, they come back to us and say, well, this is, reading data every 5 seconds is a lot more complex than we thought. Can you help us out? So there's a lot of pushback. I would say a lot, but there's some pushback on just adopting the technology. The other part of it is for a utility to get new technology like this is they have to go to the regulator and kind of plead their case on why they can charge their customers for the new technology. And so sometimes we have to wait for the assets that they currently have to go ahead and fully depreciate. So if they've got meters that we sold them maybe 3 years ago, more than likely they're not going to want to rip that out and replace it with new stuff until those assets fully depreciate, because the regulator's not going to approve it. Now we can go back to them and upsell our outcome solutions onto that hardware, or if the hardware is older, we can use that network interface card, kind of like that Roku or that Fire Stick I was talking about earlier. So they can go back to the regulator on that kind of thing. But really it's just, we have the technology that the utilities need. It's adopting that technology. We certainly like them to move faster if they could, but that's probably a hurdle that we face.
I have a question. What was the main reason behind the increased guidance, main driver?
Yeah, the revenue, we've generated more revenue, which is also fallen down to more gross profit. And so with Wall Street analysts, it's kind of a double-edged sword. You're kind of rewarded for beating your guidance, but if you beat it too much and too frequently, then they think you're sandbagging and not telling the truth. So we increased the guidance really to keep our credibility high where it is. If we knew that we were going to come in with better results than what we had guided, we wanted to go ahead and signal that to the street so that they continue to believe us. But it was more revenue, more profit, and anyone that kind of dug into it more than, analysts and buy-side analysts, sell-side analysts, they cover a lot of companies, so they can't always do a lot of in-depth research. But anybody that took some time and researched it would figure out that we're going to beat our guidance. Why didn't they raise it? So we just want to make sure that we're keeping honest relationships as much as we can.
And just to follow up with that, was that mainly due to more efficient company operations, or was that due to overall economic changes in the market?
The demand has certainly picked up. So some of it is increased demand. Some of it's company operations have been more efficient. Some of it actually, and I didn't touch on this, so that was a good question. We did have some catch-up revenue because of the supply coming back. We had about 125 million of catch-up on past due projects. That was in the first half of this year. So some of that drove it too. That's 125 million of that catch-up revenue that won't reoccur next year. But that was certainly, we didn't expect to catch up on all that 125 million this year. So that was some of the reason as well.
Thank you.
You're welcome. Connor, I know you have one. Come off of mute, buddy.
I had a question if you, well, my only thing I'm thinking about is if you guys hedge your foreign exchange risk or your foreign currency risk, because you mentioned that earlier.
That's a good question. We may have done that in the past, but I can't pinpoint exactly when we've done that. The euro, it's been a little bit more predictable. There was a couple of years ago where it was fluctuating against the dollar quite a bit, and that was impacting our results. So we weren't hedging for it at the time, but we would have to call that out in our results. So I don't believe we've hedged it before, but that's a good idea. If it gets volatile again, we might want to consider that.
Thanks.
Thanks for being a good sport for me calling you out too.
I have one more question, if I may.
Sure.
So I looked at Itron's recent investment in Elpis Squared this year.
Mhm.
And how do you guys balance these like long-term investments with making sure like your financial positions remain strong? It's like interesting to me how companies prioritize where their money goes in the short term versus long term.
Yeah, so that acquisition, it was a smaller type acquisition. I think we paid somewhere around 35 million for it. So it wasn't too disruptive to our financials. We had the cash on hand, so we didn't have to borrow any money for it or anything. But we felt like the upside potential was much greater. That's going to help us establish a bigger presence in smart street lighting. Again, that's a really small business for us now, but it has potential to be really big. So we thought, hey, it's worth spending 35 million bucks on. They were actually a partner of ours as well. So I talked about how we have like 250 partners out there. They were a partner and they were willing to sell. So that's kind of a good way to find an acquisition. If you kind of already are familiar with the company, that you know what they do, you know that their technology will integrate with ours. It's kind of big to be a no-brainer. So that's what kind of drove that acquisition, because we knew it was going to work with what we offer. You guys are really nice, by the way. You're a lot nicer than hedge funds. Funds are usually angry.
Maybe one question, another one for me. Pretty interesting just with AI and the amount of electricity that takes, and kind of just forecasting that out, and could almost like double the amount of power that we're going to need to use in just a pretty short time period of maybe 5 or 10 years. As that's a pretty new market, is that something that you guys are thinking about getting into, or is that kind of not really in your wheelhouse right now for being able to kind of meter and have some of those outcome focused products to them?
No, we're certainly aware of it, and it's going to provide a tailwind for us, or kind of upside for demand. We're not going to probably provide the meter necessarily for those data centers, because we predominantly focus on residential houses, apartments, that type of thing. But any kind of increased demand that the utility is going to be facing only helps our argument more, because we're approaching them saying you need to manage your existing supply of electricity more efficiently. And if they've got that increased load on the grid from data centers because of AI, that's only going to help our case even more. But that's kind of an indirect way it's going to help us. Right now, we don't have any plans for it to, like I said, to go put a meter on a data center. But certainly, any more load on the grid is going to help our case.
A question I had was, with your guys's like efforts to combat like power outages, because we see in the summers it gets super hot in like California and they do
Mhm.
rolling blackouts. With your guys's meters, are you able to kind of help release some of that pressure on the grids to combat those power outages? Or how does that kind of work for you guys?
Yeah, certainly. If as rooftop solar panels become more prevalent or more common, with our distributed intelligence, yes, we can harness that surplus energy and go help your neighbor power their house. And so anytime we can harness even wind power and kind of move the electrons, so to speak. I know that's not really what happens, but you're kind of moving that power from one house to the other. That's how we can do that. But really, I think what's helping, or what's going to help California even more, is letting them know when the brownouts are going to occur before they happen. We want to be able to have that predictive analysis for them, that you guys need to do something as far as, I'm sure there's a lot of electric vehicles in California. Go ahead and factor down those when they plug in, factor in only 25%, or give your customers incentive to not charge them until when there's not as much load on the grid. So that's where we could help, I think, more with the preventing the brownouts before they occur. But as I said, this distributed intelligence, with only 12.4 million out there, we need the utilities to be buying them pretty quickly to prevent those type of brownouts. Because right now, the capabilities that are out there aren't as sophisticated, and so we need the utilities to kind of move quickly before those brownouts happen.
And then another question I kind of had was, as we've seen with the election results, we know that the Trump administration kind of is leaning more towards that gas and oil outlook, and they're going less towards green and clean energy, which is kind of where you guys are focused. How do you think that's going to affect your business strategy going forward these next 4 years?
We don't think it's going to impact us much. As far as the power generation goes, it doesn't matter to us if the power is coming from nuclear or coal, and coal pollutes. We'd rather not have that. But for us, it's just about managing the energy that's on the grid, and how it's generated doesn't really matter. We can harness it if it's generated from rooftop solar, wind power, nuclear, or gas-fired peaker plants, that type of thing. So our network, our data, our intelligence will work with any kind of energy source. And as far as some of the questions I get from investors are you afraid that the Trump administration is going to roll back some of the U.S. stimulus funding that's already underway, like IIJA and IRA? But we don't think he's going to unwind those either. From what we've heard, the Trump administration has a lot bigger priorities to go after. And also those funding deals are well underway. They started making those awards a year ago. So the dollars are already flowing to our customers. They're already starting to flow to us. And we think it's probably too late for that to get unwound. So we don't think the U.S. elections are going to have any impact on our business. The demand market is going to continue to be strong, whether it's Trump or somebody else in the office.
Thank you.
You're welcome.
Well, we have a couple more minutes, so any kind of last questions from anyone before we wrap it up?
I have two.
Yeah.
My first one is in regards to partnerships or competitors. Another company I know in town is Schweitzer Engineering Laboratories, and I know they work with the grid. How does your business compete with them, or do you work with them?
I'll be honest with you, I don't think I'm familiar with them. But if they do something similar, I don't think we bump up against them in the competition. Just because most of our competitors are going to be like Landis+Gyr, Aclara, which is a part of Hubble. We bump up against Xylem and Water, or even Badger. That particular company I'm not familiar with, but potentially we could look into partnering with them. If they do something similar, that's how we typically approach it first, is how can we work together? Mainly because the utilities, we know sometimes they get so much technology thrown at them, they don't know where to start. And it helps to partner our solutions together, so it makes it just a little bit easier for the utilities to operate. But certainly I'll check that one out. That's a good point.
And then in regards to your cost of goods sold, and the EV market that you work in, how do risks across seas, like between China and Taiwan, affect your company, or do they? Or are there other risks?
So we don't operate in China. Taiwan, we get a lot of semiconductors from Taiwan. Most companies do. That's our main, I guess, link to Taiwan. But as far as electric vehicles go, we don't really have any hardware infrastructure that's going to manage electric vehicles, but software definitely. And so I think what you're asking me, if I'm giving you the right answer, tell me. If I'm off base, then tell me that too. But we don't have any exposure to China. But yeah, if China were to invade Taiwan or something like that, that would be very, very disruptive to us, but it would also be very disruptive to a lot of companies. So that would be kind of a doomsday scenario for us. So certainly there's risk there. We try to source from other locations, but the semiconductors that we need, it just is a matter of fact that Taiwan produces most of them.
Thank you.
You're welcome.
Any final questions from anyone? Well, great, David. Thank you very much for your time and that great presentation and answering those questions. And yeah, we thank you, and we're excited to do a deep dive on Itron and find those findings. And we'll definitely pass along the papers and presentations for you to see the great work that these guys do.
No, this is great. This is really fun for me. You guys, like, again, y'all were very pleasant. A real joy to present to. Usually I'm presenting in more a hostile environment. So, you know, investors, or especially hedge funds, like to find where the weaknesses are, and you guys are asking really good questions. So thank you very much for participating, and thanks for having me.
Maybe just for everyone on the call, what's a common, like, very difficult question that hedge funds would kind of dig into, and what would the answer be to one of those questions?
Hedge funds always come around at the end of the quarter and right before we announce earnings. So a lot of their questions are just really blatantly, how's the business going? How the results looking? And we can't tell them that. But what they're looking for is, if we're on video, they're going to look for our body language. They're going to look, are we ducking our head, or is our eye twitching when we answer a question? So that's kind of the hardest part. Even kind of when you know you're going to have a bad quarter, especially back during the supply constraint days when we were just getting beaten up quarter after quarter with the results. You gotta kind of keep your poker face. That's the hardest thing to do. So it's not really one particular question. It's just the kind of information they're trying to pry out of you. And then they talk to their hedge fund buddies. You know, you get off the phone with them, and if you slipped up and said something, they'll go tell all their friends that what you said, and then they'll try to collaborate they'll try to cross-reference your story. Some other hedge fund will call you an hour later and ask you the same question and see how you answer it. So, but I get paid to talk to everybody. Everybody's money's green, so I'll take the phone calls.
Awesome. I guess maybe one more just for fun is, it looks like 10% of your shares out there are short for the float. That's probably that hedge fund you're talking about. How does that 10% right now kind of compare to maybe 2022, when you had a couple negative years of growth?
The short interest actually went up when we issued those convertible notes, I think, as a hedge, probably. That tends to happen. The short interest, though, if you kind of factor out the convertible notes, it has been going down, just because we've had, I think it has been 8 quarters of beat and raise type of results. So as we've gotten more predictable, the short interest has started to drop off. But yeah, back when we were not meeting consensus estimates, the short interest was pretty high. But we've certainly been trying to work that down. You're always going to have some short interest, but we think it's at a pretty reasonable level now.
Well, great. Yeah. Thanks again for your time. And students we'll pick some good questions out and we'll shoot those over to you. But yeah, thanks a lot and have a great night, David.
Thank you very much, guys. Appreciate it. Have a good night too.
Yeah, thank you.
Thank you.
Thank you.
Thank you.
You're welcome.